In the crypto market, bull and bear cycles operate with significantly different patterns, but traditional strategies often treat them symmetrically, ignoring this key characteristic. Recently, a crypto strategy has gained attention for its sophisticated asymmetric design approach. Welcome to the Inventor Strategy Selection channel, where we focus on in-depth analysis of quantitative trading strategies with both academic value and practical significance. Traditional strategy design often overlooks a crucial issue. Crypto markets have completely different dynamics for upward and downward movements. Upward trends typically require sustained capital inflow and time accumulation, showing relatively gradual climbing patterns. Downward movements are often driven by panic emotions, presenting rapid and dramatic characteristics. The core value of today's strategy lies in its asymmetric approach to long and short trading. This strategy not only introduces the VixFix indicator specifically designed to identify market panic, but more importantly, it implements completely different trigger conditions, filtering mechanisms, and risk management parameters for long and short positions. The biggest innovation of this strategy is building an asymmetric trading framework based on market structure differences. Traditional strategies often use the same logic for both long and short trades, but this strategy deeply recognizes the fundamental difference between crypto market rises and falls. Rises need time accumulation and capital push, while falls are often emotion-driven and rapid. The core design revolves around 3 levels of asymmetric processing. At the signal identification level, it uniformly uses market panic indicators as trigger foundations, but sets different filtering intensities for long and short directions. At the risk management level, long positions use tolerant trailing stops to give trend development space, while short positions use aggressive stops for quick in and out. At the trading frequency level, it adds time interval controls for short signals to avoid excessive trading in choppy markets. This asymmetric design is not simple parameter tuning, but a systematic innovation that transforms qualitative market understanding into quantitative strategy, providing new design thinking for dual-direction trading strategies. Parameter design uses layered configuration by functional modules, reflecting the strategy's asymmetric thinking. HMA and RSI parameters handle basic trend and momentum identification, with RSI trigger levels using different thresholds for long and short directions. ATR parameters serve as volatility benchmarks, providing dynamic adjustment basis for all stop-loss calculations. The trailing stop parameter group is the strategy core. Long positions use loose configuration to adapt to the gradual nature of uptrends, while short positions use tight settings to match the rapid nature of downtrends, with time interval controls to avoid overtrading. The VixFix parameter group works through multiple statistical indicators in coordination, ensuring only genuine market panic signals can trigger trading conditions. These parameters can be flexibly adjusted under different market environments. The Williams VixFix mathematical construction embodies a quantitative analysis method that objectifies subjective emotions. The core calculation formula measures the relative deviation between current price and historical highs, establishing a mapping relationship between price distance and market panic intensity. The strategy uses dual verification through percentile ranking and Bollinger Band statistical testing, ensuring only statistically significant anomalies can trigger signals. The Hull moving average represents a technical solution to the lag problem of traditional moving averages. Through recursive calculation of weighted moving averages and square root period application, HMA maintains smoothing characteristics while reducing signal delay. HMA slope calculation enhances trend strength identification, providing directional verification for trading decisions. The RSI comparison with its exponential moving average embodies the value of relative analysis methods. This relative comparison avoids limitations that absolute threshold judgment might have, making momentum analysis more adaptive to different market environments. The signal generation mechanism fully embodies asymmetric processing thinking for dual-direction trading. Long signals use a relatively loose triple filter structure. VIX spike provides basic trigger conditions. RSI above specific threshold ensures avoiding entry in extremely weak conditions. Price above HMA guarantees trend following operations. This design reflects understanding of uptrend sustainability and gradual characteristics. Short signals use strict multiple filtering mechanisms, fully embodying cautious attitudes toward counter-trend trading. Besides basic VIX, RSI, and HMA verification, it also requires RSI below its EMA and price below long-term EMA. This multiple confirmation mechanism ensures short consideration only when markets truly enter weak states. The max bar short parameter introduction further strengthens short trading risk control through mandatory signal intervals to avoid frequent opening in choppy markets. From a statistical perspective, this dual-direction asymmetric filtering design effectively reduces specific risks of different direction trades. Long filtering emphasizes trend confirmation, Short filtering emphasizes multiple verification. This asymmetric processing matches crypto market operation patterns. The strategy execution module implements asymmetric concepts into every detail of risk management. Long position management embodies deep understanding of uptrend characteristics. Larger HRR multiple trailing stop trigger distances provide sufficient volatility tolerance space, avoiding premature exits during normal pullbacks. Moderate offset distances protect profits while allowing trend continuation. This parameter setting is based on bull market trends, typically having sustainability and resilience characteristics. Short position management adopts completely different aggressive strategies. Smaller ATR multiple trigger distances and tight offset distances embody quick in and out operational concepts. This setting matches bear market characteristics of rapid and dramatic declines. The asymmetric hard stop settings also reflect this asymmetric thinking. Long hard stops are relatively loose, while short settings, though seemingly more lenient, actually embody more cautious risk control attitudes considering strict short entry conditions and rapid market decline nature. State variable management ensures independent operation of different direction trades, avoiding risks from parameter confusion. The strategy includes comprehensive visualization elements to help traders understand market conditions and position status. The HMA line is plotted in orange to clearly show trend direction and slope changes. VIX spike conditions are highlighted through background colors or markers to identify panic moments. Position entry and exit points are marked with different shapes and colors for easy identification. The trailing stop levels are dynamically plotted to show current risk management status. Alert conditions are set for all major signal events including long entries, short entries, and various exit conditions. These visual aids make the complex asymmetric logic more intuitive and help traders make informed decisions about manual overrides or parameter adjustments. The dual-direction asymmetric design of this strategy shows significant adaptive advantages across different market environments. In bull market conditions, loose long entry conditions, and conservative stop settings can effectively capture trend continuation opportunities. Larger ATR multiple trailing trigger distances ensure position stability during normal volatility, matching bull market characteristics that need time accumulation and sustained capital push. During bear market phases, strict short filtering mechanisms and aggressive stop settings embody accurate recognition of downtrend rapidity and danger. Multiple filter conditions ensure counter-trend operations only occur under extremely high certainty situations. In choppy markets, the asymmetric parameter settings play important roles. Relatively loose long conditions avoid frequent false breakout losses, while strict short restrictions effectively control invalid trades during oscillations. Notably, the signal interval control parameter is especially valuable during sideways consolidation periods, preventing excessive density of short signals and avoiding overconsumption of trading costs. The core value of this dual-direction asymmetric processing lies in recognizing and utilizing fundamental market structure differences, rather than simply applying identical logic to different direction trades. Based on quantitative trading strategy evaluation frameworks, with special attention to the innovative value of dual-direction asymmetric design. Regarding strategy completeness, the asymmetric signal generation and risk management mechanisms for long and short positions construct a relatively complete trading framework, but this complexity also increases parameter optimization difficulty, requiring users to have deep market structure understanding. Risk management is the strategy's biggest highlight. Its dual-direction asymmetric design truly embodies modern risk management essence, using corresponding control methods for different risk characteristics. Long conservative stops adapt to uptrend sustainability, while short aggressive stops match downtrend rapidity. This design provides especially prominent protection under extreme market conditions. In adaptability assessment, the strategy's asymmetric response to different market environments is its core competitive advantage. Parameter asymmetric settings enable relatively stable performance during bull-bear transitions, but also require users to have strong market judgment abilities to choose appropriate application timing. Regarding understandability, while the dual-direction asymmetric concept is relatively easy to understand, specific parameter economic meanings and interrelationships require certain learning costs, especially for users accustomed to symmetric strategies. Innovation is concentrated in quantitative processing of market structural differences. This method of transforming qualitative cognition into quantitative design has important theoretical and practical value, providing new thinking frameworks for subsequent strategy development. Practicality has been verified as excellent. Asymmetric design not only improves strategy theoretical rationality, but significantly improves risk-adjusted returns in practical applications, especially showing obvious effects in reducing adverse direction trading losses. After in-depth analysis, the fundamental reason this strategy became popular in crypto circles lies in its accurate grasp and innovative application of essential market patterns. Dual-direction asymmetric processing is not only technical innovation, but also investment philosophy embodiment. It tells us that excellent quantitative strategies should respect and utilize market-inherent structural characteristics. If you are interested in these types of innovative strategies that embody market wisdom, we will continue introducing more cutting-edge tools with similar design concepts. Everyone is also welcome to conduct in-depth strategy research and experiments on the Inventor quantitative platform.